Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to level production and budgeted cash flows. In other words, we're going to have a situation where although we have seasonal sales differing at different points within the year, we're going to be calculating a level production, producing evenly over the year to cover those fluctuations in the seasonal sale, resulting in some ending inventory, then using that information to make our cash flow budget and our cash budget, and we will also be considering loans or financing related to a minimum balance that we will want to maintain as we go through this process. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 631 Level Production and Budgeted Cash Flow tab in the Practice Problems section. Closing this back out, we're going to go through all the information up top, then we'll have a smaller component of that information that we will use to work through the practice problem. So we first start off with our projected sales. So you can see we have the sales for the entire year. We're going to be working through the entire year here. And you can see we have a seasonal kind of sales process where we have more sales in January and February. It dips down for quite some time until we get back in towards the end of the year here, and then we got a substantial increase in November and December. Total sales for the entire year, 1,262,000. We have the price per unit that we're going to sell, $5 per unit that we're selling. The cost per unit is going to be $2. Using level production policy, so we're going to use although we have a seasonal business clearly, right, because we have more sales at certain points of the year, we might think then, well, we should have some kind of seasonal production and then try to produce low amounts at this point in time and then crank up production or crank up purchases if we're just buying and selling inventory, if we're a retail company or if we are a production company. Or we might say, hey, look, I would rather produce evenly over this time period and try to figure out how much I want to produce for the entire year, let's say, and then break that down evenly. Now, there's pros and cons to either method, because obviously if we produce evenly, we're going to result in inventory that we're going to have to keep on hand over these months that we're not going to sell as much, and then we'll sell them here at the end of the year when everything picks up. So that means we're going to have added cost of financing if we need it in order to finance the inventory that we are purchasing or creating at that point, and or we'll need to be able to store that inventory during that time period. The plus side of that, of doing that type of strategy, is that then we're going to have a cushion of inventory. So if these months have an increase in the sales, then we will have the inventory in order to make the sales if we have a higher amount than we had budgeted to do. So we'll have some inventory that we will be able to use to accommodate any increases in the sales levels. We'll also have an even production process. So if it takes labor or more machine hours or whatnot in order to produce the inventory, it would be nice if we can have a nice even production process throughout the year, and that way we can have the same amount of hours. Our employees possibly could rely on the hours. We might be able to make them more happy if we can standardize the production process in some way and be able to make a standard amount of units that can make the whole process a little bit easier rather than trying to crank up the hours at the end of the year so that we have to pick up a lot more work at that point in time, which can cause disruptions and the increase and decrease of just the flow process. So pros and cons to either method, but we're going to be doing the level production process. So the cash sales are going to be 30%. So the sales that we make, 30% are going to be cash related. The credit sales collected on the month after the sale. So when we make a credit sale, that means we're going to be collecting on it the month after the sale was made. Beginning inventory in units is 31,000. The production costs are paid in the month after purchases. So the same thing, in other words, is with accounts payable. When we have the production costs, we're going to incur, say, the materials when we buy them on account, going through accounts payable. We then pay them the following month. So the cash flows in the following month. Other cash payments are going to be 51,000. We're not concentrating so much on other cash payments. You can take more time if you want to look at the cash budgets in the prior section to look at a lot more cash budgeting here. So the beginning cash balance is going to be the 5,000. The required minimum payment is going to be 5,000. So if we drop below, in other words, 5,000, then we want to take out a loan, and so we'll consider the financing at that point in time with that. Then we have our information here, just a smaller breakout of that information that we can use to work through the practice problem. So first we're going to have the production and inventory schedule in units. So we're going to think about our production and inventory schedule. We're going to start off with January, where we had 31,000 units. That was given to us in the problem up top. I can go into right here, the 31,000. That's what we start with in terms of units. Then, and what we're going to do is we're going to assume that we want to end at the same point that we started at. So we want to end with the 31,000. We're going to produce over the year the total of this 1,262, but we're going to produce it evenly. So that means that we're going to produce that, and so we're obviously going to assume that we're going to sell that many units as well. So at the end of the day, at the end of the year, then we're still going to be ending up with this 31,000. That's how the schedule is going to be working, although we will have the even production that we're going to be doing in order to meet what we think the sales will be for the year, the 1,262,000, that's in dollars. Now we got to convert that into units so we can think about our production process schedule. Let's do that for January. We're going to have the 230,000 units up top. So I'm going to pull out the giant calculator here. Here's the giant calculator. If we take that 230,000 and we say that we're going to sell our units for $5 each, so I'm going to divide that by 5 because this is the dollar amount. If I divide it by the $5 per unit, we get to the unit amount, which is going to be the 46,000. So we're going to have the 46,000 that we're actually going to think that we sell in January. How much are we going to produce? We're not going to be producing the 46,000. We're going to be producing evenly. So evenly meaning I'm going to take the full sales over the year, 1,262,000, going to divide that by 12. And that would give us the dollar amount that we would have per month. And then I'm going to divide that by the dollars per unit, which is 5. And that's going to give us the production of about 21,033 units. Or in other words, you can think about it this way. The 1,262,000 for the year divided by 5 would give us that amount for the year in terms of units. If I divide that then by 12 months, that's going to give us, once again, about the 2133. So if we take the difference between the amount that we're going to be producing plus the beginning inventory minus the sales, in other words, I started with 31,000 units plus the production 21,033 minus what we're going to sell, 46,000, we're left with an ending inventory of the 6,033 after January. So we will repeat this process. We're going to say, okay, for the beginning of February balance, we have the same number. This is going to be our beginning balance for February, ending balance for January, beginning balance February. Production will be the same because we're doing even production. And then the sales, we're going to be picking out from up top. The sales are going to be at the 101,000 divided by 5 because we're selling them for $5 each. Therefore, the units will be the 20,200. So once again, we'll have the beginning amount, 6033, plus the production, 21,21033, minus the sales, 20,200, giving us ending inventory of the 6,867. Next month, we're going to say March is going to start at that beginning point, 6,867. Production's going to be the same because we're doing even production. The sales then, we're going to say for March is the 35,000. Sales in dollars, 35,000 divided by the $5 per unit is going to give us 7,000 units. Therefore, we have the beginning balance 6,867 plus the 21,033 minus the 7,000 that we're going to sell gives us the 20,900. Let's do it again. We're going to say April 20,900 beginning balance now. So now our inventory is starting to accumulate. We're holding on to it. We expect to sell them at the end of the year here. And so when we have our bulk that happens at the end, the production will be the same. We saw that April, we're going to have the same number for the production, 35,000 divided by 5 is going to be 7,000. So now we've got 20,900 plus we produce another 21,033 minus we're going to sell 7,000. That gives us the 34,933. Then in May, we're going to start once again with that 34,933. We're now really increasing our inventory holdings because we're going to go through the real dip in our sales numbers now, and then it'll pick up at the end of the year. 21,033 for the production, same. Sales now for May have dropped to 28,000. So we're going down to the lull The bottom point divided by 5 per unit. That means we're going to only sell 5,600 units. If we have the 34,933 plus the 21,033 minus the 5,600 we're going to sell, we're at the 50,366. That'll be our beginning balance for June. And then we're going to have the same amount of production. And then in June, we had 42,000 we're going to sell, 42,000. We're going to divide that by 5, saying that we have then 8,500 sales. So if we have our beginning number, 50367, plus 21,033 minus what we're going to sell, 8,400, we get the 63,000. Next, we have July. We say we're going to start at the 63,000. We're going to produce the same 21,033. July sales, we expect to be this 53,000 divided by $5 per unit gives us the number of units we're going to sell, 10,600. So we have our beginning inventory now, 63,000 plus the 21,033 minus what we're going to sell, 10,600, 73,433. That's our ending balance. That's our beginning balance for August. We're going to produce the same amount because we're always producing the same amount. Then we have another 10,600 we're going to sell. Same calculation because we had 53,000 income in August as well. So once again, we have the beginning balance now, 73,433 plus the 21,033 minus what we're going to sell, 10,600 gives us the 83,866 about. And then we have September. That's our starting point, producing the same amount. In September, we're going to sell, we're starting to pick up a little bit, 62,000 divided by 5. People are gearing up for, I would assume, the holiday season here, Christmas possibly. So now we've got then the 12,400. If we add this up, we're going to say the 83,867 plus the 21,033 minus the 12,400. It's going to give us the 92,500. That's going to be our beginning balance for the following month. In October, same amount of the production units. And then in October, we're starting to gear up a little bit more here. We've got the 93,000 in sales divided by $5 per unit. We're going to sell 18,600. Beginning balance at the 92,500 plus the 21,033 minus the 18,600. We still have a large amount of inventory compiling at that 94,933. But in November, that's when we really start selling. So we've got that's our beginning balance. We've got the production. In November, we're going to sell the 250,000 divided by $5 per unit, or 50,000 units. That's going to mean that we now are selling it substantially more than what we're producing, which is okay because now we have that beginning balance cushion. So 94,933 plus the 21,033 minus the 50,000. So that's going to bring us to the 63,967. Notice what we're able to do on the production side is keep producing nice and evenly, which again really is helpful for our wages and whatnot, so we don't have to have this big overtime possibly jump that would happen towards the end of the year, although we have to be holding on to that inventory for quite some time in order to accomplish that. So it's the pros and cons of it. And then at the end here, we're going to say, all right, then we got the 65,967, 21,033. We're still going to produce the same amount, even though December is going to be our biggest month. We're not worried about the production process. We're just producing just like normal, just like all year long. We don't have this, we're not, killing ourselves at the end of the year. And we're able to then sell the 56,000, which will then bring us back down to the starting point, the 65,967 plus the 21,033 minus the 65,000. It's going to give us that 31,000, which is the same point at which we started. So we got this even production process that we're taking a look at. Now let's consider this to think about our cash flow budgeting, which we've seen in a prior section. So this will be familiar. We'll do this a little bit more quickly. If you want to go back to cash flow budgeting itself, take a look at the prior section. We'll do many more example problems with it. So we're going to then say we're going to assume the prior December is 100,000. So we're going to say, all right, then the sales in January, we're just picking up these numbers, the 230,000 to the 280,000, and just applying them out in our schedule this way, January through December. And then we're going to be looking at our credit sales. Now the credit sales, we said that the sales for cash are 30%. And we're picking up these amounts, by the way, because these are not our cash flows, but this is the information we will need to calculate the cash flow. So we got to start with the sales that we're going to think is going to happen, then take a look at the credit sales so that we can see when we're going to collect on the credit sales. So the credit sales, if I had 100%, 100% minus the 30%, we'd have 70% is going to be credit sales. In other words, if we have 30% that's going to be for cash, 70% is going to be on account going through accounts receivable. So for example, if we had the 230,000 times the 0.7, we're going to say 161 is going to be what we're going to get on the credit sales, what we're going to sell on account, those items that are going to go through accounts receivable. For the 101,000 times the 0.7, we get the 70,700 and so on and so forth for the credit sales. Now we can use this information then to calculate the cash receipts. So now we're thinking about our actual cash receipts. So now we have the cash receipts sales that happen here. We can calculate this two ways. We can say, well, I can take the total sales, 230,000, the ones that we're going to sell for cash, getting cash at the point in time the sale was made in the same period, times 0.3, 30%. That's the 69,000. Or we can say we have the 230,000 minus the credit sales that we just calculated. The 161,000 means we have the difference being the cash sales. You can do that all the way across. So you can take the 101,000 times the 0.3 is the 30,300, or the 101,000 minus the 70,700 is going to be the 30,300, and so on and so forth. Notice that this is a really good, all these tables are really great to practice in Excel, so I highly recommend doing these in Excel. Then we got the cash receipts. We said that we're going to receive the money that on the credit sales in the following month. So we're going to receive the money that on the credit sales in the following month. That's why we need this credit sales column. So we had sales in December last year of 100,000. So the 100,000 last year times the credit sales portion, which was 0.7 of it, that's what's going to be received in the current year. And then we just got this staggering effect across, right? The January sales that were credit sales are going to be collected in February. The February sales that were credit sales will be collected in March. The March sales that were credit sales will be collected in April. The April sales that were credit sales will be collected in May, and so on and so forth. If we add this up, then the total cash receipts, the 69 and the 70, is the 139,000, the 30,300, and the 161, the 191,300, the 10,005, and the 70,007, 81,200. Then we think about the cash payment schedule. So on the cash payment side of things, we have the 42,067. That's going to be resulting from our production process. And you'll recall that with our production schedule, we calculated up top, we have an even production process. So we did this even production process all the way across. Therefore, we're going to be consistently producing the 21,033. And if we purchase those, or if those are materials, these are purchases on account, we're going to always be running through the accounts payable with that production or purchasing process. So we're then going to be taking that 21,033, and it costs $2 per unit. So I'm going to say divided by times 2, and that's going to be our 42,067 about that we're going to have. There's rounding involved here, and that's what we're going to have the entire for the entire year. That's why we have the even production process. And then the amount that we are going to be, or the other cash payments that we're going to be having on that, is going to be the 51,000 for other cash payments. So if I was to add those two up, we're going to say the cash payments then are going to be the 93,67. Notice we're not spending a lot of time on the cash payments, and we're not spending a whole lot of time on the production process, because the new thing here is really this production schedule, where we had the even production schedule up top, and now we're going to apply that to the cash payments. We'll also think about the loan that will apply out that applies to this as well. If you want more detail on like the cash payment schedules and whatnot, we did that in a prior section. We have a whole lot of problems that you can look into on that. Taking those two schedules, then we can then make the cash budget. So the cash budget we're going to make is going to be applied to this rule. We have the beginning balance was 5,000, and we don't want to go below the 5,000 minimum balance. So you can see what happens is with our production schedule, you can see that when we start to get through this lull in the year where we're not making as many sales, but we're producing just as many inventory because we have an even production, we're going to start to run into points where we get low on cash. Most likely we'll need a loan in order to do this. and then we'll get to the end of the year when we'll pick up on all the sales, and then we should be able to pay off the loan at that point. That's what we would assume kind of to happen with this, schedule that we have in sales that's seasonal, even though we're doing an even kind of production process. So if the beginning balance, for example, and we should probably do that, let's do that this way. We'll pick this up this way so we don't see every year. All right, so here's a better revealing thing. So we got the beginning balance of the 5,000. That's where we start. The new cash flow is simply going to be the change that we have up top. So we have the inflow of the 139,000 minus the 93,067. So we've got a change of the 45,933. If we take that and add it to the 5,000 beginning balance, that would be our ending cash before considering a loan. It's well above the beginning balance, and we currently have no loan outstanding. We're going to say, therefore, there's no loan activity. So our ending balance is also going to be that 50,099, and that's going to be then our loan balance is at zero. We have no loan because we're over the 5,000 and don't need to be calculating the loan. And then in February, we're going to say that our beginning balance is going to be the same as our ending balance. In the prior period, the change or in the cash flow is going to be the receipt cash flow, the 191,300 minus the 93,067. And then if I add that to the beginning balance of the 50,933, we're going to then get to the 149. Once again, that's over the 5,000, so we don't have to take any loan out or do anything to that number. Then if we go on over to the next one, we're going to say this March is going to be our beginning balance, is going to be the same as the ending balance. We're going to say now that we have a loss or a cash net outflow, 81,200 minus the 93,067. So now it's a decrease. If I add that to the beginning balance, the 149,167, we're still okay on cash. We're over the 5,000, therefore no loan or anything is needed, nothing happening to the loan balance. So then if we move this on over to the next month, we're going to say, all right, then we have the beginning balance in April is the same as the ending balance for March. We have the activity happening, which is the 35,000 minus the 93,067. So we have a loss or net outflow plus the beginning balance of the 137,300. That's going to be over the 5,000 still, so we don't need any loan activity once again. So let's move on over to May. So in May, we've got the same beginning balance as the ending balance for the prior month. We've got the change here, which is the 32,900 minus the 93,067. And then if we add that to the beginning balance plus the 79,233, we're going to get the 19,067. Once again, that's over the 5,000, so we don't need any loan that's going to be taken out. So let's move on to the next one here. So now we've got June, and June is going to start at the same beginning point as the ending point for May. We have the difference getting larger here, 32,200 minus the 93,067. So cash outflow, if we add that to the beginning balance plus the 19,067, we're at now a negative flow of cash. Therefore, we have to take into consideration a loan because we want to have a minimum balance of 5,000. So I'm taking that minus 5,000 means we need to take out a loan of the 46,800. And so that's going to bring us to our minimum balance of the 5,000. And now we have a loan outstanding of that 46,800. So if we move on over to the next one, we're going to say, all right, now we're in August. Let's move this on over to August. It's getting harder to move because of the little sliver thing. All right, then we're going to say 5,000 is our beginning balance. Now we have, again, a big loss here. So 45,300 minus the 93,067. And if I add that to our beginning balance that we had because of the loan of the 5,000, that's going to give us the 42,767. Once again, we're going to need another loan to get us back up to that 5,000 minimum balance. So I'm going to say minus 5,000 means we need 47,767 to take out in the loan to get us to that 5,000 minimum balance. So that brings us back to the 5,000 minimum balance. And now our loan amount was at 46,800. Now we took out another 47,767 right there, meaning our loan amount now is the 94,567. All right, and then we're going to go to the next one. So we'll go to August. So let's bring it on over to August here. August is at 5,000, our beginning balance. Then we have the change that's taking place, which is going to be the 53,000 minus the 93,067. And that's good. Let's do that again. Something went wrong. I had a fly just flew in my face when I was trying to calculate. So 93,067, that's the 40,067. If I add that to the 500 plus 5,000, we get the 35,067. And then we have to do something to get it back up to that 5,000 minus the 5,000 balance we want. We need another loan of the 40,067 to get back up to that $5,000 balance. Our loan balance now is climbing. We're at the 94,567 plus the 40,067, which is this number here. That gives us to the 134,633 on the loan. Moving on over to September, we're reaching the end of the year, which we should be making money at the end of the year. So we started at the 5,000. We're still in the negative on the cash flow at the 55,700 minus the 93,067, 37,367. If I add that to the 5,000 plus the 5,000, that's going to give us to the 32,367. We need to get up to the 5,000 minimum balance, so minus the 5,000. That means we need 37,367 loan to get to the 5,000 minimum balance. Our loan's still climbing. We were at 134,633 plus 37,367, which is this number here, brings us to the loan balance at the 172,000. October, we're still on a negative cash flow in October, but November, that's when everything's going to work out for us, hopefully. So we're going to say we got the beginning balance plus the change here, so we're still on the negative 71,300 minus the 93,067. So we're on the negative cash flow plus the 5,000. We're at the 16,767. I need a minimum balance of 5,000, so minus 5,000. We got to increase the loan by the 21,767, and then our loan balance then was at the 172,000 plus the new amount 21,767. So now we're up to 193,767. November, that's when we start making sales, though. That's when the stuff happens the way it's supposed to happen. It's supposed to happen this way all year long. So then we got the 5,000, and now we're in the positive here. So now we've got the 140,100 minus the 93,067. So a net increase on the cash flow. That's good. And then if I add that to the 5,000 beginning balance, we're at 52,033. And so now we can start to pay back some of our loan. So I'm going to pay back as much of the loan I can to get us back to that $5,000 balance. So I'm going to say minus 5,000. So I can pay back 47,33, and that'll give us to that $5,000 balance. And our loan then goes down. We were at 193,767 minus the 47,033. That brings the loan down to 146,733. Our beginning balance once again at 5,000. The net change we have is going to be the 259,000 minus the 93,067. That's the 165,933 plus the 5,000. So we're at the 170,933. That's well above the $5,000 minimum. We can pay off the entire loan balance with that and still be above the 5,000. So I'm going to pay the entire loan off, which is the 146,733, and that'll get us to the 24,200 that we're left with, and the loan balance now is back down to zero. So that's going to be our cash flow. So you can see this process in terms of the loan, of course, because we're producing evenly throughout the time period and we're financing portion of it, we ended up with this big loan amount that then hopefully we will be able to pay off at the end. And that's in order to support the fact that we're carrying that inventory because we have an even production until the point in time that we sell it. So again, there's pros and cons to using that process as opposed to trying to reduce these amounts by lowering the production in these lull areas and then having a super jump up in production, at the end of the year to be ready right for that time period when we know the sales will be boosted.